So welcome everyone to the CBER session on alternatives to proof of work. So I can just quickly share my own thoughts. I'm pretty excited for all three papers that I think that especially the economics are very different between proof of stake and its variants compared to proof of work. And it's not as actively researched as the proof of work model yet. So I am pretty excited to hear about the papers. And we can get started. Thomas Rivera is going to be the first speaker. And Thomas, you can go ahead.
All right, great. It's a pleasure to be here. This is joint work with Kose and Fahad Saleh. And this is a paper on equilibrium staking levels in a proof of stake blockchain. So just to motivate this idea a little, we know that blockchains are governed by a set of rules. These rules are typically referred to as consensus protocols. And what we see in practice in terms of the existing blockchains, in general, there are two of the most popular classes of consensus protocols are proof of work and proof of stake. So proof of work was the original consensus protocol. And as motivated by this session, proof of stake is sort of a rising competitor. Just to give you an idea what I mean by that, right? Ethereum is currently planning on switching from a proof of work to a proof of stake blockchain. This will be called Ethereum 2.0. And after this switch, the proof of stake blockchain universe market cap will be more than half of the proof of work market cap. So this will represent a sizable fraction of the universe of blockchains. So in general, and again, motivated by this session, the literature has focused on proof of work consensus. And this makes sense because proof of work came first. And in that literature, we've studied things like mining incentives and pooling resources and miner extractable value. And some of these concepts, though, are highly specific to the proof of work consensus protocol. So in general, there's been less work on proof of stake consensus. And the subject of this paper is to study equilibrium staking incentives, the sort of analog to mining incentives. Now, before I go into what exactly we're looking at in this paper, I just want to give a very high level idea of what is staking. So in practice, many proof of stake blockchains will have lots of differences, but this we think is sort of some of the main commonalities between these proof of stake blockchains. So in general, the proof of stake blockchain is going to maintain and update the blockchain through a process called staking. Any investor that holds the cryptocurrency can stake that cryptocurrency at any point in time. And then the staked cryptocurrency is going to be held dormant. And this is going to allow the protocol to achieve consensus through this process. So what's going to happen is at predefined intervals in time, the protocol is going to select one unit of cryptocurrency from the set of staked cryptocurrency. The selection is going to be done uniformly at random. And then the owner of that unit that's selected is going to be allocated the right to update the next block in the blockchain. Okay, so that's how these blocks are going to be added. That's the selection process. And already this is very different from the way that proof of work updates the blockchain. So in general, staking is going to require holding your cryptocurrency dormant. And in exchange for this, the protocol is going to guarantee you some return, which will be paid out via block rewards. So every time that you're selected to update the next block in the blockchain, the protocol is going to guarantee you some reward for this, which is going to be the block reward. Now, the blockchain is sort of a closed system, so there's no funding going in or out. So basically, in order for the protocol to guarantee you this payment, it's going to have to do that by issuing new cryptocurrency. So you're selected to update the next block. And after doing so, you're going to be issued this new cryptocurrency as the reward. Now, the object of study in this paper is going to be the equilibrium staking level, which we're defining as the market value of all staked cryptocurrency. And this is a very important sort of variable for a proof of stake blockchain because it's going to be highly linked to the security of a proof of stake blockchain. In particular, taking over the process, the block creation process, is going to involve a cost that's going to be proportional to the equilibrium staking level. And so in that sense, if you want to make the cost of attacking the blockchain prohibitive, then you're going to have to ensure a high staking level for your proof of stake blockchain. Now, because of the fact that staking, the reward for staking is these block rewards, generally speaking, sort of abstracting from fees, this is the guaranteed reward that you get. It sort of generates a natural intuition, which is that if staking levels are low and you want them to be higher, well, let's just increase the block rewards and that will increase your staking incentives. And the point of this paper is to show that this natural intuition is actually flawed. There is a much more complex relationship between block rewards and equilibrium staking levels. So in some cases, in many cases actually, increasing the block rewards will have the opposite effect on equilibrium staking levels, causing them to decrease. Okay. So just to give you a preview of the results, we're going to model staking incentives when agents have different trading horizons. And that's going to be a core feature of the model that drives a lot of these results. So once we impose this condition, what we're going to see is that these block rewards, because of the fact that they're paid by issuing new cryptocurrency, they're actually going to create redistribution from short horizon investors to long horizon investors. In general, the short horizon investors are going to dislike this, and this is going to lower the level of investment coming from these short horizon investors. In contrast, long horizon investors will enjoy these extra block rewards, but it's their relationship, their investment levels are going to also depend on short horizon adoption. So this is just going to lead to our main result, which I'll try to explain in more detail later, which is that staking levels are going to have an inverse U-shaped relationship with block rewards. In particular, staking levels are going to be increasing in block rewards when they are low and decreasing in block rewards when the block rewards are high. So what I want to do now is just give you sort of the overview of the model, and then I'll be able to sort of give you some of the core intuition as to why we have this relationship between staking levels and block rewards. So we're going to model this sort of proof of stake blockchain with discrete periods. In the proof of stake jargon, these periods would be called epochs. So you have some fixed intervals of time. The blocks are going to be added within the epoch. So for Cardano, for example, the epoch would last 5 days. And then the important thing about these epochs is that if you want to stake, then you're going to have to do it before the epoch starts. Okay, so I will come back to that later as to why that's important. So then we're going to have a measure of agents arriving in each period. They're each going to have some endowment, and they're going to look to invest that endowment in either the proof of stake cryptocurrency or some alternative outside option. We're also going to allow our agents to have heterogeneous outside options, so they're going to be continuously distributed. The thing that this buys us is that now continuous changes in the payoff from investing in the cryptocurrency will lead to continuous changes in the investment levels. So now the core feature of the model is that at the start of each period, these agents, conditional on purchasing the cryptocurrency, they're going to receive a liquidity shock with a fixed probability. So at the start of the period, they flip the coin. With probability theta, they receive the liquidity shock, in which case they have to liquidate all of their holdings. They're going to do this by selling these holdings to the newly arriving agents in that period. Okay, with probability 1 minus theta, they don't have to liquidate their holdings, so they hold them one more period. And then with the same probability, the coin gets flipped and the liquidity shock realizes or it doesn't. Once these agents liquidate, they entirely leave the model. Okay, now we're going to allow for 2 types of agents. So some agents are going to have a high probability of receiving the liquidity shock in each period, and other agents are going to have the low probability. So these are, we're going to refer to respectively as short horizon and long horizon investors, with the idea being if you have a high probability of receiving a shock, then you're going to have a shorter expected trading horizon than if you have a low probability. Okay, so these are the sort of main difference between our investors in their trading horizons. Now, the investors are optimally going to stake until liquidation. So conditional on purchasing the cryptocurrency, it's going to be optimal for you to stake that until you receive your liquidity shock. So agent I staking their cryptocurrency at time t plus 1, they're going to have holdings that evolve according to this formula. And basically, so my time t plus holdings are going to be equal to my time t holdings plus this additional term. And this term represents the fraction of block rewards that I expect to earn in that epoch. at time t, epoch t. Okay, and this fraction is very simply just going to be the amount of crypto holdings that I stake divided by the total amount of crypto holdings. So given that this is a uniform lottery, this is going to be the fraction of blocks that I add to the blockchain, that I'm chosen to add to the blockchain. And then this is going to be the total block rewards paid out over the epoch. So this is the expected fraction of block rewards that I expect to receive. So naturally, you can see here, staking is going to be optimal because if you don't stake, then your cryptocurrency is just going to stay constant until you liquidate, right? Your holdings won't have this opportunity to grow. Now, on the other hand, so these investors, when they arrive, they're going to pay an inflationary cost when they're purchasing their cryptocurrency. And the reason for this is that I need my transaction posted within the epoch that I arrive in order for me to own the cryptocurrency. But of course, I won't be able to stake that until the next epoch starts. And there's also going to be block rewards issued in the epoch where my transaction gets posted to the blockchain. And so that's going to represent some inflationary costs that I don't have the opportunity to recoup until I start staking in the next period. And our investors, it doesn't matter whether you're short or long horizon, they're going to face the same inflationary costs when they purchase the cryptocurrency. So what we're going to show is that the long horizon and the short horizon investors are naturally going to recoup different levels of this inflationary cost. So this is going to create different incentives for investing in the cryptocurrency for these two types of investors. Now, before I go there, I just want to introduce a sort of benchmark result. So this is a simple case where all investors have the same trading horizon. Okay, so if everyone holds for the cryptocurrency for the same expected amount of time, then what's going to happen is their payoffs are going to be invariant to changes in block rewards. Okay, if their payoffs are invariant, then so are their staking and adoption decisions. And so this leads to the natural result, which is that equilibrium staking levels are entirely invariant to block rewards when investors have homogeneous trading horizons. Okay, so now even then in this simple case, the natural intuition is violated because if I increase block rewards, basically I shouldn't expect to see any change on the equilibrium staking levels. And the intuition behind this is, again, all investors are paying the same inflationary cost. And when investors have the same trading horizons, they're going to earn in expectation the same amount of block rewards. And this is sort of a zero-sum game in the sense that the total inflationary cost each period has to be equal to the total amount of block rewards paid out in terms of their value, in which case all investors, they pay the same cost and they earn the same rewards, and those rewards have to be equal to the cost in expectation. So it has to net out, all right? So in this sense, the investors don't care whether you have high block rewards or low block rewards, right? Higher block rewards means more inflation now, but it also means I'm going to recoup more rewards in the future, and that's perfectly going to offset the increased inflationary cost now. Okay, so now going back to the case where we have both short and long horizon investors, our first preliminary result, as I mentioned earlier, is that block rewards create redistribution from short horizon investors to long horizon investors. So in the context of the benchmark case, you might be able to already anticipate why this is happening. So basically the long horizon investors, they're going to stake longer. So they're naturally going to recoup more of the inflationary cost by earning more block rewards in expectation. But again, this is a zero-sum game. So the total rewards and the total costs have to net out, which means if long horizon investors recoup more of the inflationary cost, then short horizon investors have to recoup less. Okay, for this reason, short horizon investors are going to dislike increases in the block rewards. It's just going to represent more redistribution to the long horizon investors. So short horizon investor payoffs and adoption are going to be strictly decreasing in the block rewards. Long horizon investor payoffs have a more nuanced relationship with block rewards in the sense that we show that they're going to be increasing when the block rewards are low, and the long horizon investor payoffs are going to be decreasing when the block rewards are high. So before I give you a little intuition on this, just want to show you some illustration of these results. So here we have the long horizon investor payoff in red, the short horizon investor payoff in blue, and the equilibrium staking level in black. Row here represents the cryptocurrency growth rate. Okay, so that's how you can interpret these numbers on the bottom. And the cryptocurrency growth rate is going to perfectly determine how many block rewards are issued each period. So increasing the growth rate means increasing block rewards. So as I mentioned on the previous slide, the payoff to the short horizon investors is strictly decreasing in the block reward level. And you can see it flattens out here. And this is the level at which the payoff for investing in the cryptocurrency as a short horizon investor is less than their worst outside option, which means in this case, when block rewards are above this level, no short horizon investor will invest in the cryptocurrency. Now, the long horizon investor payoffs flatten out here, and this is an illustration of the benchmark result, whereby when there are no more short horizon investors, there's only one type of trading horizon for any investor that invests in the cryptocurrency, and now they're completely indifferent between the level of block rewards in this case. Okay, same thing for the equilibrium staking levels, right? Again, in this case, there's only long horizon investors, so the equilibrium staking levels will not vary with block rewards. Okay, now let's go back to the case where where we have both types of investors. So just to explain this idea about long horizon investor payoffs, why they increase and then decrease. So basically there's two effects on long horizon investor payoffs when you increase block rewards. The first one is just to increase the expected rewards that they receive, right? So this is just going to increase the level of redistribution to these long horizon investors. So they typically like that. There's also going to be an indirect effect though, which is that as you increase block rewards, you decrease the number of short horizon investors, and this is going to decrease the magnitude of redistribution. And basically what we're going to show is that when block rewards are low, the direct effect offsets the indirect effect because there's still a large mass of short horizon investors, so there's still a good deal of redistribution. But as soon as block rewards get too high, now the indirect effect is going to dominate, right? In the extreme case where there's no investors, right? There is no redistribution. Sorry, the extreme case where there's no short horizon investors, there's no redistribution. Okay, so now these sort of implications on payoffs are going to lead to implications on the investment decision of the long and short horizon investors. Higher payoffs means more investment by that type, lower payoffs means less. And this is going to map to our main result, which is that these equilibrium staking levels have this inverse U shape. Okay, first increasing in block rewards when they're low and then decreasing. So to help sort of explain the intuition behind this, first, let's just recall that the equilibrium staking level, so this is steady state staking level, this is going to be the market value of staked cryptocurrency. And when we solve for this, this is going to depend on two important equilibrium variables. The first one is going to be demand from new investors for the cryptocurrency. So naturally, as the demand from new investors increases, the equilibrium staking level is going to increase because this is going to push up prices. It's going to push up the market value of the cryptocurrency. And everyone investing in the cryptocurrency, except those liquidating, are going to stake. Okay, so the market value of staked cryptocurrency is going to go up with the demand from new investors. Another important equilibrium variable is going to be the average trading horizon of a new cryptocurrency investor. So as the average trading horizon increases, the demand for staking over time is going to increase as each investor is going to hold that cryptocurrency longer, right, and therefore stake it longer. Okay, in that sense, increasing the average trading horizon is always going to increase the equilibrium staking level by sort of restricting the amount of cryptocurrency available to other users, pushing up demand, and also just increasing the expected staking from each investor. Okay, so now going back to this case where we have low block rewards and the block rewards are, the staking levels are increasing in block rewards. The intuition behind this is that when block rewards are low, increasing those rewards is going to decrease short horizon investment, and it's going to increase long horizon investment. And what the main effect this is going to have is to increase the average trading horizon, because now you're just going to have just more long horizon investors. So the average trading horizon of a new investor is going to go up, and this is going to offset the decrease in the adoption. So the second effect is going to dominate. It's going to be stronger than the decreased adoption of the short horizon investors. And this is precisely because the long horizon investors are also increasing their adoption. So these two effects are going to offset each other. In that case, it's the average trading horizon effect that dominates, causing this equilibrium staking levels to increase. Now we can contrast this to the case with high block rewards. So with high block rewards, when you increase these block rewards, both payoffs of the long and short horizon investors are going to be decreasing. And in that case, you're just going to get outright less investment in the cryptocurrency. So the equilibrium price is going to go down. Okay. And what we show in the paper is that for sufficiently high block rewards, this decreased investment is going to offset any changes in the average trading horizon of the new cryptocurrency investors. Okay. So for this reason, when your block rewards are sufficiently high, the staking levels are going to be decreasing in the block rewards. Okay, now there's one other corollary that I would like to present that I think is going to be a very important sort of implication for design and improvement of blockchains. And this corollary says that we prove this in generality, that you can be much worse off setting block rewards too high as opposed to too low. And you can see this from this graph here, right? If I set block rewards too high, I can get this very low level of equilibrium staking levels. Whereas if I set block rewards close to zero, I can only do this worse, this bad, excuse me, right? So the idea then is if I don't know where I am on this curve, I could be much worse off setting block rewards too high as opposed to just setting them very low and close to zero. And the design of Bitcoin might have given us this idea that we should start off with large block rewards and then slowly decrease them over time. And this is giving the sort of the opposite intuition, which is that if you don't know where you are on the curve, you don't know the levels of investment, then what you should do is just start off with low block rewards and slowly increase them over time to figure out where you are. Right? Again, this would be the less risky choice, because if I start with very high block rewards, I might get very low staking levels and therefore very low security of the blockchain. Okay, so we think this is an interesting idea, especially if you're considering starting a new creating a new proof of stake blockchain. You might have this thought, well, let's set high block rewards so that we can get high levels of staking and high security at inception. And this may actually be the wrong approach to this. And our results are suggesting you might want to start with much lower block rewards because the incentives are not as clear as we previously thought. Okay, so let me just quickly conclude. So the security of a proof of stake blockchain is going to crucially rely on these equilibrium staking incentives. So the block rewards are supposed to be what drives the incentives to stake. It's the guaranteed reward that you receive for staking. So this leads to this natural idea that higher block rewards will always lead to higher staking incentives and higher security for a proof of stake blockchain. What we're showing in this paper is that this intuition is flawed in the sense that, so the reason why it's flawed is that these block rewards are going to create redistribution from short horizon investors to long horizon investors. And this is going to generate a non-trivial relationship, an inverse U-shaped relationship between staking levels and block rewards. In particular, staking levels are going to be increasing in block rewards when they're low and decreasing when they're high. And we hope that these are going to be some important insights taken into account for the design and future improvements of proof of stake blockchains. Well, that's all I have. Thank you.
Awesome. Thank you very much. So we do have time for questions. If anyone would like to answer some in the Q&A, I have one that I'll start with. One thing from the more like security of the consensus side that's relevant for like lower level incentives is sometimes having epochs be really long. Like you have to commit your stake to staking super far in advance of when you can actually use it. Helps security because, the longer in advance you have to make the decision, the less information you have to possibly try and manipulate a protocol. And so I guess in your language, that maybe would like bias the distribution to be like towards longer term investors just because the epoch is much longer.
Exactly.
Is it possible to conclude like from your model whether that would have a positive or negative impact on the staking level?
So you mean longer epochs?
Yeah, like so for example, say that the intervention I'm considering is making the epoch longer, which would shift the distribution of long versus short-term investors. Is it possible in your model to see like how a shift like that would impact the optimal equilibrium staking level or something like that?
Yeah, so this shift should lower equilibrium staking levels just in the sense that a longer epoch is going to impose a higher inflationary cost on the short horizon investors. And so this is going to, they're going to anticipate this, and they're going to invest less in the cryptocurrency. And so this is going to, the first effect would be to increase the level of redistribution. So you'll get more investment from long horizon investors, but this is going to crowd out some of these shorter horizon investors. So I think it's natural to think that, yeah, long horizon investors would be the ones more interested in staking now. But for staking levels in general, right, you're going to lose out these short horizon investors, and the aggregate effect is going to be, it's going to look like this inverse U shape. And the question is, how does it shift? And my expectation is it's just going to shift down, because you're going to get less investment for the same level of low block rewards, right? So for any level of block rewards, you're going to get less investment from short horizon investors. This is going to have to pull down the redistribution that the long horizon investors get. So that would be my expectation, but it could be a nice extension to sort of work out.
Got it. Thanks. And then I can also see a question from Larry Wall. So I'll allow you to talk if you want to read it out loud.
Okay. So I thought there was some reference to alternative investments early in the discussion, but I didn't see it later on. So I'm asking, are optimal staking levels dependent upon the interest rates paid on alternative investments, such as fiat-denominated money market instruments? If so, then setting too low a level could lead stakeholders to shift fund to investments to fiat currency investments. And that could be especially important at a time when fiat rates are rising.
Yeah, so I completely agree that these outside opportunities have to depend on other things like fiat inflation. We're taking this more as sort of an exogenous function there. The distribution of these outside options, we think they could possibly vary cross-country, or at different for different types of households, the outside options could vary. But yeah, so basically what we would do to incorporate this idea is to just have that the mean distribution or some of the features of the distribution of the outside option be dependent on things like fiat inflation rates and maybe other, like the risk-free rate or other types of market variables. And I think you would get the intuitive results that you would expect. If the outside options are now less attractive, then investment in the cryptocurrency is going to be higher, and so will the equilibrium staking levels, keeping all else fixed. And yeah, if investment in outside options are more attractive, you're going to get less investment for the equilibrium. For the proof of stake.
So what I was really getting at is if there's time variation in the real returns on alternative investments, and you fixed your block rewards in the protocol.
Yeah, so this is sort of out of the scope of the model, just because we're studying steady state, so we're thinking like long run here. Yeah, I think I agree that it would be interesting to study some short run phenomena, like some time variation in staking levels due to some exogenous shocks. But it's just a little bit outside of the scope of what we're studying here, which is kind of a first pass long run analysis.
Thank you.
Thanks.
And then we'll take one last question, Hanna, if you wanted to ask.
So maybe a little bit clarification. So Thomas, I think you said that the increased demand for the currency, therefore increased prices, are going to make staking more attractive. Is this what you said, or I misheard it?
No, so it's going to, so higher demand for the cryptocurrency will increase the prices. But the point is, the effect this has on the equilibrium staking levels is that the staking levels are not, it's not the raw amount of cryptocurrency staked, it's the market value of the cryptocurrency staked.
So because I'm wondering, the price of the cryptocurrency should not matter, because you are staking in cryptocurrency and then you're getting reward in cryptocurrency. So this is like a fixed, you're multiplying both sides of the equation by a fixed number. So if you are getting, block rewards are 2%, your return on investment is 2%. Doesn't matter whether the price is $1 or $2. So how does the price really enter into the benefit of staking?
Right. So Yeah, I see your point there. The important part why we care about the price is, again, because the staking level, like which determines security, is going to be the market value of that crypto the market value of the staked cryptocurrency. So if prices go up, it might not affect the investors' investment decisions. I mean, we're studying a steady state where prices are constant, but hypothetically, outside of the model, it might not change their investment decisions, but it will still affect the equilibrium staking level and the security. So because the price goes up,
thought
the
that
value
answer is that the answer is that you have an exogenous outside option. So the price,
yeah,
the price times the thing you earn should be
that's what your
compared to the
payoff
outside
is.
Yeah,
Yeah,
outside
that's
option,
what-
and the outside option has nothing to do with the price. Therefore, the price enter into the decision.
Yeah,
Is that
so
right?
we're taking the outside option to be exogenous to the price.
That's fine. That's fine.
Yeah,
Just to clarify.
Thanks. Thank you.
sure.
Awesome. Thank you. So I see that there are still some questions in the chat, so maybe answering those in text, or we can revisit them after all the talks are done too. And Brett, if you would like to start sharing your slides, we can move on to your talk.
All right, can everybody see my screen and hear me?
Yes. And all right, so the next talk is by Brett Falk, and go ahead and get started.
Yep, this is joint work with Gerry Tsoukalas and Alon Benhaim, and we're going to look at committee-based consensus. And so we saw in the last talk this notion of Nakamoto consensus, where block producers are chosen by a lottery mechanism based on the amount of either in Bitcoin, the amount of hash power they have, or in a proof of stake setting, it can be by the amount of stake they have. And so like blockchains like NXT use this exact mechanism of Nakamoto consensus, where you select a single block producer by a stake weighted lottery instead of a proof of work based lottery. And in these cases, proof of work and proof of stake are these kind of Sybil resistance mechanisms for using this lottery. But there's a lot of alternative consensus mechanisms that still can use proof of work or proof of stake, but have a different kind of consensus. And so we're going to be focusing here on this type of committee-based consensus. So instead of electing a single block producer who produces the block, and then choosing a chain based on this sort of longest or heaviest chain rule, like it's done in Nakamoto consensus in Ethereum and Bitcoin, you can elect a committee of block producers, and this committee can then run a classical consensus algorithm. And most of these classical consensus algorithms have some threshold that as long as 2/3 of the committee is honest, meaning they sort of follow the protocol or they run the vanilla version of the software they're given, this committee will reach consensus on a single block. And this type of committee-based consensus is used in a lot of protocols. It's used in these delegated proof of stake systems like Tron and EOS. It's used in almost every chain in the Cosmos ecosystem, including the Cosmos Hub. It's used in Algorand and also on the Binance Smart Chain, which is basically a fork of Ethereum that's running proof of authority. And there's a lot of potential benefits of a committee-based consensus. So some of the arguments are that it allows kind of a specialization, that if you elect a committee, this can be a committee where they have good hardware and high network high network throughput and low latency. And so you can speed up the blockchain a little bit because you have these professional producers. One of the big benefits, though, is that you can get instant finality. So in Nakamoto consensus, you can have basically the chain can fork, right? The consensus is reached by a longest chain rule. And so in Bitcoin, for example, there's a heuristic that you don't consider a transaction finalized until it's buried 6 blocks deep. It's not once you see your transaction in a block, you have to wait for some amount of time until you're pretty sure you're on the longest chain. Whereas in chains with instant finality, as soon as you see your transaction in a block, you can be fairly sure it's finalized. And so these chains that use Nakamoto consensus, right, see a lot of these short-term forks. So Ethereum has basically at minimum about 100 uncles a day, which are blocks that get uncled out and don't end up making it to the longest chain. Bitcoin has many fewer because the block time is much longer, but they still see about 1 uncle per month. And so that's, that's something you have to worry about if you're you want your transaction to go through. And this is something you can get rid of with these committee-based consensus protocols. And it's a big selling point for a lot of committee-based consensus schemes. One thing I'm kind of interested in is committees can also do other things. If you elect a committee, you can force the committee to all use specialized hardware like Intel SGX, and then you can make the whole blockchain secret. And that's what the secret network does. Or you can force the whole committee to run some distributed key generation algorithm and encrypt their mempool. And so you can have a private mempool and get rid of a lot of the problems of MEV. And this is what Osmosis is planning to do. You can also ask the committee or even a different committee to hold secrets and have private information on the blockchain. And so the Algorand Foundation has a number of papers that outline sort of how you would elect these committees to hold secrets for you. You can ask the committee to be price oracles, so you don't need to have external price oracles. So like Terra, the Terra blockchain, right, their whole ecosystem is based on price oracles because all of their synthetic coins like UST are based on knowing the real-time market price between US dollars and their native token Luna. So they need price oracles. Instead of having external price oracles, they take their block producers to be price oracles. And since you have a committee of block producers, this is a good way to do this. The Binance chain even uses a committee elected on the Binance chain to choose the committee on the Binance Smart Chain. So you can have this committee of block producers control another chain. And so there's a lot of kind of interesting things you can do with a committee that make this type of committee-based consensus fairly appealing, I think. Now, there's the big drawback of committee-based consensus is that these classical consensus protocols require communication that grows quadratically with the number of people in the committee. So if there's n people in the committee, it requires n squared communications. You have to keep the committee size kind of small. So small is relative and nobody knows exactly what small means. EOS uses 21 block producers, Tron uses 27, Cosmos, most of their chains use 150, Oasis uses 110, the Binance chain uses 11, the Binance Smart Chain uses 21, and the one exception here is Algorand, which does a lottery-based consensus, ends up using a lottery-based committee selection, ends up using a lot more committee members, and I'll talk more about that in a little bit. But this type of small committee, even if you elect new committees all the time, the committee can end up being static. And so you see this really extremely in systems like EOS. So EOS elects a new committee every 2 minutes, about every 126 seconds. They elect 21 people at a time. In the first 89 million blocks they produced, they only had 63 different block producers produce all of them. And even Cosmos, which does a little better, the Cosmos Hub, had only 215 block producers for the first 9 million blocks. By contrast, right, Ethereum in the first 8 million blocks were mined by more than 5,000 distinct addresses. And Bitcoin, if you count the number of addresses that were paid out to in block rewards, you get up to about 275,000. And so these committee-based consensus protocols are much more centralized than the alternatives. And so this is a big drawback of these systems. But nevertheless, a lot of places use them. So most of the Cosmos chains, including Cosmos Hub, Crypto.org, which is Crypto.com's chain, Terra, the Secret Network, Osmosis, many more, the Binance Smart Chain, Algorand, Tron, EOS forks like Telos. So this is a really widely used method of coming to consensus. And so I think it's important to understand how these work. In terms of this, in terms of seeing hands, I see some hands going up. Should I take those questions now? How do I even get back to that?
I think that's okay if you want to keep going. So I would encourage everyone to put questions in the Q&A. And some of them we can try and answer during the talk if it's a clarification question, but I think typing it into Q&A first would be better.
Okay. Sorry, yeah, I just didn't have the window of participants open to see I just get messages. So the purpose of this talk is to ask basically how you should elect the committee. So first question is who's sort of allowed to vote? and you need some sort of Sybil resistance mechanism. And all the chains I mentioned all use proof of stake as their Sybil resistance mechanism. You get votes proportional to your stake. But in principle, you could do this with proof of work, and people have proposed actually using proof of work where your voting power to elect a committee is proportional to the amount of hashes you do. But that's not what we're focusing on. We're focusing on here on the voting mechanism. How do you elect a committee? So the simplest thing to do is to say you have a single vote mechanism. You get one vote to elect somebody to a committee. Your vote is proportional to your stake. And then you look up at all the candidates and you select the K candidates who get the most votes, and that's your committee. And you run this election maybe every 2 minutes, every 5 minutes, once a day. You get to set that parameter, but it's just a single vote mechanism, and your vote is stake weighted. And this is by far the dominant method for committee-based consensus elections. An alternative method is through what's called approval voting. And I'm going to talk a bunch more about that. But in approval voting, you don't vote for a single person. You approve of any number of candidates that you want, and they all get the full weight of your vote. And at the end, we count up who has the most approvals, and the candidates with the most approvals are elected to the committee. And finally, alternative method is just a lottery-based mechanism where you just have a stake-weighted lottery, and you choose K people at random proportional to their stake to be on the committee. And so we're going to look at how these different committee selection mechanisms perform. So the main question here is, what's the best way to choose a committee? So let's start with the lottery-based mechanism, because that's kind of the simplest. So in the original Algorand paper, they say, if we assume that 80% of the stake is held by honest people, and we're going to elect a committee of size K, then we can actually figure out what is the probability that 2/3 of the elected committee is honest, right? And that's when consensus will fail. And that's when you could have a fork or a double spend attack, and you would lose this instant finality. And so they can do an analysis. It's very straightforward, right? To say, well, the probability of a random committee of size K being elected and having more than 1/3 dishonest or less than 2/3 honest is the probability of binomial distribution with K samples with probability 0.8 is less than 2K/3. And you can calculate this exactly. And they give some suggested parameters in the white paper of saying, we wanted the chance that a malicious committee, a committee that's more than 1/3 dishonest or less than 2/3 honest is selected, and they choose some parameters like 10 to the minus 12. You want this probability to be less than 10 to the minus 12 under the assumption that 80% of the stake is honest. And with this failure probability, if they produce a new block every 4 seconds, so like a new committee, say every 4 seconds, it takes, there's an expected time of 128,000 years before you elect a committee that's 1/3 dishonest, because these concentration bounds are really very strong. Right, the binomial is very highly concentrated. And you can get a nice bound if you just take the turnoff bound, the probability that a binomial where you select n people with probability p, the probability you're more than a 1 minus delta fraction away from your expectation decreases exponentially in the committee size n. And so in this case, if 80% of the stake is honest, so in this case, P is 0.8, then the probability of a dishonest committee decreases like e to the minus n/90. This is an upper bound on this. So you can be sure that you won't get a committee with, a dishonest committee with more than this probability. So it decreases exponentially. So if you make n big enough, you can make your probability of a bad committee go to 0 exponentially quickly. And so this is the determinant. This is how they choose how big their committees are going to be. And one of the arguments for doing this is basically that incentives are really complicated. And so Algorand sort of very publicly adopts this sort of incentive-free design. So there's no rewards for block producers, there's no slashing for misbehavior, and there's no voting because they say it's really hard to design these kind of incentives. And the cost for that is they have to have bigger committees. By contrast, most of these other systems have some method for electing committees. And the main question is, can you do better with voting? Can you basically make the committee size smaller, which would make your whole chain more efficient by having some voting to try to tap into the wisdom of the crowds about how you select committee members? So we model this by saying basically you're trying to elect a committee and there's a binary outcome. It's either a good committee or a bad committee. And it's a good committee if some fraction, say 2/3 of the elected people are honest. And it's a bad committee if less than this fraction is honest. And this is the model that's used in most cryptographic analysis. And this is also the model that's used in most classical consensus protocols, where there's some sharp threshold that as long as more than some fraction, like 2/3 of the people follow the protocol, then you're guaranteed to come to consensus. And below this threshold, sort of almost anything can happen. And in our model, we assume voter incentives are aligned. Everybody wants to elect an honest committee, but they have very little information, right? When you were voting for block producers on some chain like Cosmos, you have very little information about who's going to be a good block producer or not. And to simplify things, we ignore the secondary characteristics about candidates that you might care about, like uptime or latency, right? You would like to elect committee members not only who are honest, but who are going to be really fast at producing blocks, because again, you could increase throughput that way. But that's not really part of our model here right now. So in approval voting, you get to approve of a set of candidates, and the weight of your approval is proportional to your stake. And then the system aggregates the K candidates who got the most approvals, and they're elected to the committee. And now this is strictly more general than a single vote system where you are allowed to only approve of one candidate. In approval voting, you can approve of any number you want. But one of the drawbacks of approval voting that's been noticed in, a long time ago is that it's a voting system that there's not a unique honest strategy. So even honest voters need to be strategic, and you kind of see this right away. If there are 4 candidates like A, B, C, D, and your preferences are B first, and then A, and then D, and then C, you have to choose. Do you vote for just B, or do you vote for B and A, or do you vote for B and A and D, or do you vote for all 4 of them? And these are all consistent with your preferences, and you have to choose, and your strategy is now going to depend on what you think other people are going to do. And so this is different from like single choice voting, where if you're honest and not strategic, there is sort of a natural, a single unique strategy. So in approval voting, the voter decision process is kind of hard. So here's our model. We have n candidates, and each candidate is honest with probability P, and we have n voters. And each voter receives some signal about the candidate J. So you get some signal Sij star, and it's coming from a normal that's centered around some piece of H for honest producers and centered at some lower value for malicious producers. And from this, you can calculate the posterior probability that candidate J is honest based on your signal. And so what is a voter going to do? They're going to look at all these signals, these posterior probabilities of voter I has this posterior probability Sij that candidate J is honest or dishonest, or that it's honest. And in approval voting, you get to choose the top Z producers to vote for, the top Z candidates. And in regular single vote voting, you just get to choose, you just choose the top one. So there's no strategy there. But the question is, how should you set this optimal threshold? How many people should you vote for? You see these posterior probabilities, you rank the producer candidates based on the probability you think they're going to be honest. And now how many should you vote for in order to maximize the probability of electing an honest committee? And a big question is this much better than, can you do, clearly in this very simplified model, you're going to be able to do better than single vote voting because it's strictly more general and everyone's incentives are aligned, but do you do much better? And is that worth this extra cost of basically making it unclear what voters should do? So we know that if all voters acted optimally in approval voting, they do better than single choice voting, they do better than lotteries because our model is simple, but it's not clear if they pursue a suboptimal strategy, right? They may actually do worse than single vote voting, or they may, they could even potentially do worse than lottery-based elections. So let's see kind of what happens. So first is, let's look at what kind of strategies could voters take? So we identify two types of strategies that are sort of very natural. One is kind of a threshold, we call it threshold voting strategy. You vote for everybody you think has a better than, say, 75% chance of being honest, or better than a 50% chance of being honest. An alternative strategy is a cardinal voting strategy, which is you vote for the top 5 people, or the top 7 people, regardless of what their probabilities of being honest are. And these seem like two very natural strategies that people might want to pursue. These are not the only possible strategies. The strategy space is really complicated, but let's look at these to begin with. So in the threshold voting strategy, you just, you get your signals and you have these posterior probabilities Sij, and you vote for all candidates that are bigger, whose probability is bigger than some threshold. And now we can actually calculate explicitly what is the number of votes that an honest candidate gets and what's the number of votes a dishonest candidate gets. And we can actually calculate this distribution explicitly. And it turns out it's a Poisson binomial distribution. And then we can actually calculate a closed form solution for the probability that a committee of size K is 2/3 honest. It depends on the order statistics of these two different Poisson binomial distributions. So we get a closed form, but it's really, really messy. But we can now plot this. And so this plot shows this is not a simulation. This is actually like an evaluation of this closed form. And imagine the single vote setting. And we have a single vote setting, and they're going to vote for everybody. The x-axis is what their threshold for voting. Here, this is if you vote for everybody you think is a 40% chance of being honest. This is the chance you vote for everybody who has a 60% chance of being honest. This is the chance you vote for somebody who's an 80% chance of being honest. And the idea is there is actually a single optimal here. And it's about 66%. It's kind of what you'd think, that you vote for people who you have a 2/3 chance of being honest. And intuitively, this makes sense. If you vote here, you're voting kind of for too many people. You vote for almost everybody, and you can't distinguish honest from dishonest people. Everybody gets one vote. And if you vote here, you're not voting for anybody. Nobody gets any votes. And again, you can't distinguish. But there's this optimal threshold where you're kind of distinguishing honest candidates from dishonest candidates, and your vote is actually conveying some information. So this looks really good. But the problem is, the second you go to 2 voters, now all of a sudden, the optimal strategy is not at all clear. Now you have 2 voters. If they both vote for too many people, this is the region where all the candidates essentially get 2 votes. And now here, you get a nice differentiation. If people vote at this level, they vote for people who are 55% chance or more of being honest. Then the honest candidates will get 2 votes and the dishonest candidates will get about 1. But if you deviate from this optimal strategy a little bit, you totally kill your chances of electing an honest committee, because now essentially this is the case where I guess everybody is getting 1 vote. The honest and dishonest people are getting both 1 vote. You can't distinguish them anymore. And if you raise things a little bit, then the honest people get 1 vote and the dishonest get 0. And then back down here, nobody gets 0. And so this is kind of worrisome that once you have 2 voters, the optimal strategy is now very, very delicate. If you're off from it, you are in bad shape. And if you have 3 voters, you get 3 peaks. And if you have 4 voters, you get 4 peaks. The one nice thing is once you get a lot of voters, the peaks kind of merge. And so here's what happens with 100 voters, that the strategy already now is becoming like pretty robust, that if you follow a threshold strategy, you have a really high probability of electing an honest committee, essentially no matter what you do. So this is kind of nice. And this is sort of what you would hope for, that these strategies would be robust because they're very hard for voters to calculate. So let's look, what if people follow the cardinal voting strategy, where you vote for the top candidates regardless of what their signal is? There's some evidence. We scraped votes off of EOS where they do approval voting, and it looks like people are following these kind of threshold voting strategies. So there are spikes here. This is the number of people you vote for. There's spikes at like 21, but the committee is size 21. So a lot of people, I think if the committee's size is going to be 21, I'm going to vote for 21 people. And EOS imposes this arbitrary threshold that you can't vote for more than 30 people. And a lot of people just vote for 30. They say, I'm going to vote for the maximum. So it seems like people are maybe following this this cardinal voting strategy on EOS at least. And the nice thing is we can show if there's only one voter, or if all the voters pool their information, cardinal voting is indeed optimal. This is actually strictly better than threshold voting. And again, these aren't simulations, these are the actual probabilities in the case that you have one voter, that when the committee size is 21, you get all of these things have peaks at 21. Unfortunately, once you have more than one voter, cardinal voting is no longer optimal. And it's almost impossible to find optimal strategies. But you can simulate things. And so we were trying to look, one of the big questions here was about, is approval voting basically better than single choice voting? These are the two sort of dominant ways that people are electing committees. And so we can imagine, suppose all voters followed a cardinal threshold. They vote for the top 1 candidate, top 2, top 3, top 5, top 10. And here, right, we see this is what happens when people vote for one candidate. So this is like single vote elections. And this is the probability they elect an honest committee. And these are the lowest. And these two lines represent basically how much information candidates have, right? So in the green things, voters have more information. In the purple, they have less information. But in both cases, right, we see that single vote voting is the worst of all approval voting. It's better if you let people vote for 2 people. It's better if you let them vote for 3. It's better if you let them vote for 4. And it tends to get better. And this horizontal line is the probability of electing an honest committee. So we have the a priori probability that somebody who's honest in this plot is 75%. And so if you elect a random committee with people of 75% probability, what's the probability 2/3 of the committee is honest? It's about like 75%. Here it's like, and so this is fixed. It doesn't depend on a voting strategy. Right? But this is already interesting because now we see, like, it looks like approval voting, even if voters have very, very little information, is better than single choice voting. And if you increase the committee size, so that was with committees of size 21, which is like what EOS uses, and what BSC uses, and here's committees of size 150, which is what Cosmos uses. And so all the probabilities go up. You're much more like, the bigger the committee, everything goes up. The probability of randomly selected committee is 2/3 honest, is already now almost 99%. But we still see that single vote voting is basically the worst of all of the approval voting options, even with these kind of larger committees and with voters having very little information. So one of the sort of take homes from this is all of these methods converge exponentially quickly, even lottery-based consensus. They all converge exponentially quickly. And in approval voting, even though you can't figure out what the optimal strategy is, the approval voting is actually very robust to sort of almost any strategy works very well. But even with suboptimal strategies, like we know that voters following a cardinal strategy is suboptimal. There's some strategy they could use that's much better. But even with these suboptimal, very simple strategies, you end up with systems that are actually much better than just single choice voting. And so sort of moving forward, right, there's lots of other election mechanisms that we haven't thought about at all, right? We focused on approval voting because that's what's being rolled out in some of these things, but you could use quadratic voting, you could use ranked choice voting, there's many others. And it seems important to figure out, how do you want to elect these committees? Because this can be sort of divorced from all the other aspects of the system, right? You can choose these systems have different virtual machines, right? Binance Smart Chain uses the Ethereum virtual machine, Cosmos uses CosmWasm, right? Like, you don't have to focus on this. You can change your ideas of block rewards, but this question of how do you sort of elicit information from the users about how to select a committee seems really important. And it can be sort of tweaked independently of all of the other aspects of the system. And another thing we'd like to sort of do moving forward is, right, make the model richer. Right now, all of our voters, their incentives are aligned. They want an honest committee. But what if some fraction of the voters are malicious, or some fraction of the voters really care about performance? Or if there's vote buying, this is actually a topic of discussion. There's lots of vote buying on these systems. It's very easy to set up contracts where you can pay people to vote for you as a block producer, and then you can share your block rewards with them. And so this type of vote buying is really prevalent in these systems. And how does that change things? So I think a really interesting question. So thank you.
Awesome, thanks. So actually, I was going to ask a question that you also preempted a little bit. It looks like you preempted Andreas's question as well, but maybe I can still ask whether you have any intuition for whether like a simple modification to approval voting, like say there's just 2 tiers, like you strongly support and okay support.
Yeah.
Like, is there any way to get intuition, or you just have to like dive into the calculations and see what happens?
I don't know. I personally don't have intuition about that. If you could say like there's a strong vote and a weak vote. I mean, I think it gets very close to then ranked choice voting, right? That you say this is my first choice, this is my second choice, this is my third choice. And my intuition is probably that ranked choice voting is better. Again, I think all of these things, I mean, we spent a while, I started this trying to think that there would be an easy way to, I thought it'd be like a fun mathematical exercise to just find the optimal strategy. I was like, I was just like, you know, is the optimal strategy you vote for everybody who's more than 2/3 chance of being honest if you want the committee to be 2/3 honest, or is the optimal strategy you vote for everyone who has a 50% chance of being honest because that has a chance of increasing your committee, right? Like, but I was like, the answer is one of these 2 things. Let's just do, you know, write down some numbers and figure it out. And the answer is not either of those things, and it's like totally impossible to figure out. And I think, right, yeah, as soon as you get to you know, you think making things more complicated, like, you know, tiers or ranked choice or something, right? The optimal strategies then even, yeah, maybe get crazier, but yeah. So I don't really know. But the nice thing is that all of this is very, very robust, right? So that's the one sort of thing that I like about it, right? It's like it all seems to work pretty well, both in practice and, you know, in theory, concentration bounds are just very strong.
Yeah, nice. I think we should move on to the last talk.
Okay.
And Hanna, you can begin as soon as you're ready.
Okay. So thank you very much. I'm very happy to present this work in such a great company of a paper presented by Brett and by Thomas. This particular work is joined with Zhiguo He and Jiasun Li, and it is motivated by the observation that a lot of the new generation blockchains are using Byzantine fault tolerance consensus mechanism. So this is the type of a consensus mechanism that Brett referred to as a classical consensus mechanism, for example, in delegated proof of stake systems. And the Byzantine fault tolerant consensus mechanisms, they rely or they refer back to a very classic problem of Byzantine generals problem that goes back to the late 70s and the 80s. And in fact, we have well-functioning distributed databases that are using the Byzantine fault tolerant solutions and consensus mechanisms, and very successfully since they were developed in the 80s. Now we see a resurgence of interest in Byzantine fault tolerant protocols because of the increased interest in blockchains and the use in the new generations of blockchains of these BFT mechanisms. Now, there is a difference, a very meaningful difference between blockchains and traditional distributed databases, and this particular difference is of special interest for economists. So, in traditional classical distributed databases, the applications were set up within one company. So we could have nodes that are failing or nodes that are hacked, and those are the Byzantine faulty nodes. But otherwise, we would assume that the nodes are following the prescribed protocol with which they were programmed. And this is what we call honest nodes. And Brett in his talk referred a lot to honest nodes and honest participants of the system. So this is kind of an adversarial environment in itself, because we need to worry about those hackers and failing nodes. But moving from traditional databases to blockchains changes the nature of this adversarial environment, because we no longer can assume that the nodes that are non-Byzantine are just honest, because now we have validators of validators in this distributed databases that are their own independent entities, and they are profit optimizing or payoff maximizing at their individual levels. They may rationally decide whether they want to follow the protocol or not, depending on the expected payoffs from following the protocol or not, and diverting from the protocol. So now we no longer have the environment with honest nodes versus failing and hack nodes. Now we have those self-interested rational nodes that need to decide whether they follow the protocol or not in equilibrium. And on top of that, we still have the failing nodes and possibly hack nodes, the Byzantine nodes. So what we are doing in this paper, we are taking an economics lens to this shift of this adversarial environment, and we are asking what is the effect, or how this shift is going to affect the stability and performance of the system in equilibrium. So the classic fault-tolerant protocols make several assumptions, and the most important ones here are that first, Byzantine nodes, Byzantine faulty nodes, can behave arbitrarily. We don't really know what they are going to do. They definitely do not need to follow the protocol, but we don't know in which way they are going to divert from the protocol. For non-Byzantine nodes, however, it is assumed that they will be honest in the sense of following the prescribed protocol. Most importantly, Byzantine fault-tolerant protocols are devised for peer-to-peer networks where none of the nodes is more important than others. This is why we have no trusted third party, no node that holds authoritative version of the ledger of the database. Everybody is equally important, and that means that each node needs to decide whether to update its own local version of the ledger based on the local information that they are receiving from other nodes. And no entity in the system has a global view on all the information that is being sent in the system. Okay? So we recognize that in blockchain environments, the non-Byzantine nodes are not just honestly following the protocol, but they are rational payoff maximizing entities. And moreover, they are ambiguity averse about Byzantine strategies because Byzantine nodes can behave in arbitrary matters. So they can take any strategies, any probability. So we go with ambiguity aversion. Okay. So in our analysis, we are using a simple game, simple framework that we call a consensus game. And this game is a game between a continuum of mass n of computer nodes, and it follows in a couple of stages. So first, a nature randomly selects one node as a leader, and all other nodes at this time are called backups. Then the leader decides for each backup whether to send a message, right? And the message in the context of blockchain may be a new batch of transactions that will need to be added to the local versions of the blockchain for each node. So leader decides whether to send a message to each one of them, and then each backup who received a message from the leader decides for each other node whether to forward the message. And this we call peer communication stage. For backups who have not received a message from the leader, they cannot forward the message that they didn't receive, so they can really not do anything. They have no decision to make. After the communication stage, each node needs to decide whether commit the message based on its local information, based on the number of messages that then confirmations and forwarded messages that they got. And committing on the message is equivalent to updating its own local version of the ledger with this new information. And in our picture here in the illustration, all of the nodes are committing to the message, and therefore we are reaching consensus. That means that everybody updated their ledger exactly the same way, and now we can say that they all have a copy of the same ledger. But note that this is actually a non-trivial thing. When we keep talking in the context of blockchains, that there is the blockchain, there is no the blockchain. There's just many, many copies of the blockchain, and they are not being just copied from a single source. Instead, they are the local copies need to be constantly updated with little incremental pieces of information in a way that nodes know that everybody else has also updated it the same way. Okay? So this particular setup is a backbone of all Byzantine fault tolerant mechanism protocols. And yes, we can add all sorts of blogs and whistles, but this would be the core that we will be using. Of course, since we are talking about Byzantine fault tolerant mechanism, we need to account for the fact that there will be Byzantine nodes who may be taking arbitrary actions and not following the protocol, or not even profit optimizing, payoff optimizing within the system. So we assume that there is, out of our measure N of all the nodes, there is a measure F of Byzantine nodes who may behave in arbitrary way. The challenge in Byzantine fault tolerant systems or in Byzantine faulty systems is that we don't know which of the nodes are Byzantine. If we knew, we would just exclude them and then would proceed with all nodes that are non-Byzantine. Now, as for the remaining N-F non-Byzantine nodes, the classical Byzantine fault-tolerant protocols, they assume that those nodes will just honestly follow the protocol. Instead, we say that they are rational and they are maximizing their payoff. Therefore, we need to specify what are the possible payoffs for different decisions that the nodes are making. So, for each node, after the communication stage, each node is making a decision whether to commit message or not to their local ledger. And if a node commits the message and the consensus is achieved, then the node receives a reward R in that situation. However, if the node commits the message and the consensus is not achieved, that now this local ledger of this node is different than the local ledgers of other nodes, and or at least of some other nodes, and therefore the node receives a penalty C for having lack of diverging ledgers. And what do we mean by when I say that consensus that we reach consensus or that consensus succeeds? This is when almost all rational nodes commit to a message. So if all rational nodes update their ledgers in the same way, this is when we say that we have consensus. So you can see that we have here a dynamic game with imperfect information that is in its nature a coordination game, because every rational node wants to commit if other rational nodes commit as well, and they don't want to commit if other rational nodes are not committing, with features of sheepdog, because the communication stage is not directly entering the payoffs. The payoffs are depending directly only on the commit decision. Okay. So in this context, we are going to apply perfect Bayesian equilibrium with multi-priors over Byzantine strategies because of the ambiguity aversion. Okay. So our contribution here is to interpret blockchain Byzantine fault-tolerant protocols within economic frameworks so that we can derive further insights and implications for system stability and system design. And the first thing that we do is we characterize all symmetric equilibria in our simple game. So we start by setting up a candidate symmetric equilibria, and then we derive conditions under which those equilibria exist. So a candidate symmetric equilibrium would be characterized by the probability with which rational leader sends a message to each backup. So now we are switching to symmetric strategy. This is why we have just one probability for each backup. And the leader sends message to each backup with probability P. Then rational backup who has received a message forwards this message with probability Q. Now, after this peer-to-peer communication stage, the backups collect the number of messages that they got, and a committing rule is part of the equilibrium, where a backup commits if it receives some number of messages, including one from the leader, and possibly a different number of messages when he did not receive a message from the leader. Okay, and this is going to characterize an equilibrium. Now, what we are showing is that we always can get a non-consensus equilibrium where no matter what messages are exchanged, all nodes decide not to commit. But we are really interested in consensus equilibria where the messages are sent around, and we ask under what conditions we can get an equilibrium where the system achieves consensus. For any candidate equilibrium with given P and Q and in environment characterized by a number of nodes N and a number of measure of faulty nodes F, a node receiving a certain number of messages can make a couple of inferences from the number of messages that it received. So first of all, for given P and Q, if the leader is rational and sends messages with probability P, and all rational nodes are forwarding the messages with probability Q, then any node is going to receive a number of messages within a very well-defined interval between n minus f times P and Q and n minus f times P and Q plus fp. So the difference is whether, if all rational nodes behave according to the equilibrium. The difference in the length of this interval is what do the Byzantine nodes are doing, whether they are sending or not sending their messages outside of what the protocol in a way would be prescribing. So if a node, rational node, knows that this in a given candidate equilibrium, this is the interval that is consistent with rational leader, then receiving any message, any number of messages outside of this interval directly tells him that the leader must be Byzantine. Okay? Now, for the number of messages within the interval, we cannot say for sure whether the leader is rational, because Byzantine leader can also mimic rational leader. So there is still uncertainty whether the leader is Byzantine or rational. Now, the second thing that the node can infer from the number of messages that it receives is the number of messages other nodes are receiving. And this again depends on the behavior of Byzantine nodes. And basically, for any number that a rational node is receiving, it knows that a number of messages that other nodes are receiving are within a certain bound. And if the leader is Byzantine, that means that other nodes are receiving plus or minus f of the messages, right? So that means that if I'm a rational node and I have received less than f messages, I know that other rational nodes, other nodes can receive f more messages than me, but also some other rational nodes may get 0 messages because they can get f my number of messages minus f, and that would be, of course, is bounded by 0. Those two inferences are going to help us or they are actually helping the nodes to make a decision, the commit decision that would be the best response and is going to get us to the equilibrium. So, like I said, if a rational node received less than f messages, then the node knows that some of the other rational nodes may get 0 messages. If they get 0 messages, they may be, they just cannot commit, no matter what their strategy is, they cannot commit to message that they never received. And if there is a positive measure of those nodes, potentially positive measure of those nodes that do not commit, the best response for me is not to commit as well, because as ambiguity to ambiguity aversion, I'm taking the worst case scenario. So I'm not going to commit if I got less than F messages. Now we can use the iterated elimination of dominated strategies. We started with F, but we can iterate it further. If I get 2 F messages, by the same token, I know that there may be some positive measure of rational nodes that got F or less messages. They are not going to commit, so therefore my best response is not to commit as well. And we can iterate it all the way until we get to the other side of the interval that is consistent with the rational leader. So how do we know that we are always going to get on the other side of the interval? This is because the interval is no longer than F. And therefore, since we can iterate by Fs, we're going to be able to go on the other side. Now, if there is some positive measure of nodes that are not going to commit because they got too many messages, that for any number larger than this, I'm also going to consider possibility that there will be some other nodes that got fewer messages than me, and they are not, but in this red interval, they are not going to commit, and therefore I'm not going to commit. So with that, I'm never going to commit a message for the interval that is consistent, for which I know that the leader is Byzantine. Okay? So I'm never going to commit there. How about the interval where the leader may be Byzantine or rational? So first of all, we show that either for the whole interval we commit or we don't commit. Then there's always an equilibrium where we just don't commit because there's just 0 coordination equilibrium. But most importantly, we show that there exists equilibria where we commit whenever we get the number of messages within this interval, and it depends on the relative value of the reward and the penalty, as well as the probability that the leader is Byzantine versus rational. And we derive the particular conditions under which those equilibria exist. And we fully characterize all symmetric equilibria. We find the conditions on the parameter space, and then we look at the possible equilibrium strategy. Okay. So now you can agree that those are really cool equilibria. This is a really cool game, and we had a lot of fun finding the results. But the question is, why does it matter that we find this equilibria? And what we want to argue is that we already know that operational success of any blockchain depends on its design. And there is large research literature on the proof of work design of the blockchain. We have heard about other design choices in proof of stake. And what we are doing is we're showing that accounting for incentives in Byzantine fault tolerant consensus, which should be accounted for if we are talking about blockchain environments and not just distributed databases deployed within particular company. If we account for incentives, then we show that all designs are subject to multiple equilibria concerns, and the equilibrium selection is a real problem. And then the existence of kind of good consensus equilibria depends on the relative value of the rewards and penalties or punishments. And yes, we can basically either say that maybe those parameters are restricted by the environment, or like Silvio Micali, we can throw our hands and say we're not going to set those parameters because they are too difficult to set, and we're just going to maybe look for some other randomness in the environment. But it can also be a decision of the system designer. And our results may help guide those decisions rather than doing it by trial and error or saying that it's too difficult. So, to summarize, we developed an economic framework to analyze incentives in Byzantine fault-tolerant protocols so that they can be used in the context of blockchains, which should provide a guidance for maintaining reliable distributed ledgers among the self-interested parties rather than just honest nodes. And in our framework, we are focusing on information imperfection rather than maybe operational costs that are also playing a role in maintaining those distributed systems, right? And the information imperfection is something that is difficult to take away. This is an intrinsic challenge in distributed systems, in peer-to-peer systems, where decision needs to be made based on local information. Thank you.
Awesome. So like before, if anyone has questions they would like to ask, you can throw them in the Q&A. I will ask one first though. So one thing, so I think when I was listening, the thing that like I am curious about is for the specific communication model that you have, if you could assume that the non-Byzantine nodes were honest, like how much are you, like, is it possible to quantify how much you're losing as a function of RNC in terms of like ability to reach consensus or something like that? Or does that not make sense in this model?
So yes, we can basically plug f being equal to 0, right? Right, and if f is equal to 0, right, there are no Byzantine nodes. If Byzantine nodes are rational, well, so here's one thing: is we say that Byzantine nodes can do anything, can behave in arbitrary matter. And some people say, well, we can interpret it as they are crazy, they can do whatever. But we can also say they are rational. We just do not know what is their objective function and what are their payoffs. Whereas for our rational nodes, we assume that they are maximizing payoffs within the system, right? So I don't know whether you're asking whether the Byzantine nodes are rational in this broader sense, or whether we basically have no Byzantine nodes in our system.
Sorry, I was saying, so the Byzantine nodes I was asking would still be Byzantine, but the like I guess how I understood it is the classical computer scientist would say, the honest nodes are honest. You can tell them exactly what to do. And then the new thing that seems very nice to me is, like we all know that we have to model the honest nodes as rational. And then this is a pretty, clean way to model them as rational. And something that I feel like would be helpful for me to get intuition for is like, so here's like one specific communication model. And if we could understand in this model how much you lose by having rational instead of honest non-Byzantine nodes, then maybe that could give some intuition for like the super complicated communication models, which are probably, it doesn't make sense to go directly to those models and, like reanalyze everything, but we might be able to get some intuition by like, what is the gap in the simple communication model that you have to be able to like get some intuition for what the gap should be.
So let me give you one example, right? So if we, so I'm on this slide with symmetric equilibria, and let's look at the unitary P equilibrium. This is where the leader always sends with probability 1 a message to all the backup nodes. And then basically for any Q, for any probability of forwarding, we can have an equilibrium as long as we get this particular condition on the relative RNF satisfied. And if we could tell nodes to just follow the strategy, we can get consensus even when when there is no RNC. However, with rational nodes, this condition on RNC needs to be satisfied for them to want to follow this protocol. Otherwise, they will not. So this would be like a really back of the envelope answer to your question.
Can I chime in a little bit? So Matt, I think your question is a fantastic one. We didn't think through is that what if a fraction of our rational nodes are honest, and the system will tell them what to do. You can think about it, those guys are very reputationally, costly to deviate, and then you can ask, how big, just index the fraction of a rational among the good guys, right? Good guys could need incentive, could just just to follow through as a really nice citizen. But so that then becomes three agents. Then you can analyze this game. Hanna, I think that's a good direction to analyze that.
Yes, but I did not think that this was. I agree. Though this is not how I interpreted Matt's question.
Okay, that's my interpretation on that question.
Which actually is great for the future direction. Yes.
So may I also just say one word? Sorry, I was traveling, so the background noise is a bit bad. So in the paper, so we did actually calculate the surplus from every equilibrium. So just kind of like complementing what Hanna just said, right? So if if the condition for this R and C is not satisfied, so then we would only have this non-consensus equilibrium, and we know what the surplus to the stakeholders are, and also we can compare that with the equilibrium in which, like for example, the unitary P equilibrium is reached. So that difference can give us precise characterization of the surplus loss.
Awesome, thanks. Okay, so I think we should wrap up. So thank you to all three speakers, and thank you to the audience.